Investors Chronicle.
Welcome to the Companies and Markets Show, the podcast that gives you expert analysis on all the latest market and listed company news. I'm your host, Dan Jones, and this is what you need to know. Welcome, everyone. Spring is here, but we begin the show today by contemplating a different kind of change that may be in the air, specifically the suggestion that a great rotation out of US shares and into Europe and even the UK may now be underway. Our associate editor, Alex Newman, and deputy companies editor, Julian Hofmann, will debate this premise shortly and ask what the possible implications might be for private investors. Asset allocation is also the focus of our big read this week, which is all about how the very rich invest. Alex will discuss what we know about the investment practices of so-called ultra-high net worth individuals and whether there are any lessons or indeed warnings out there for the more humble everyday investor. Lastly, we will turn our attention to UK company reporting in the shape of Close Brothers, which put out interim figures earlier this week that were pretty badly received, to say the least. The shadow of motor finance rulings still lingers over the company, but there are other concerns there too. Julian will discuss those later on in the show. As I say, though, we are going to begin with the look at the contrasting fortunes of US and European shares in recent week, and contrasting in an entirely different way to how investors have been used over the past couple of years, Alex. I think what we should maybe start with is the Bank of America Fund Manager Survey, which is a high-profile, as the name suggests, study of investors, professional investors' views and how they've changed month on month. And it's fair to say, after the share price slump we've seen in the US in the last few weeks, that the survey put out this week showed some pretty big changes.
Yeah, I mean, if you read the report, I mean, it's really not short of shocking headlines. I mean, there was, I think one of them, the March report showed the biggest drop in US equity allocation on record. That's quite amazing and quite a reversal compared with what we've, all become accustomed to in the last decade, really. The drop in the level of sentiment, how quickly it's happened month on month, also quite shocking. Maybe the most for me, I thought, and we can, obviously unpack all the drivers of this real about face in fund manager sentiment, was the inference, I think, from the report. The B of A said that for the S&P 500 to head back above 6,000 points this quarter, that there would have to be a complete reversal in this, all the fears around inflation and trade war concerns. It seemed a really slim prospect of that happening, given the world we seem to have entered in recent weeks. And there's clearly a rising prospect of the thing everyone is worried about, which is a trade war sparking some sort of global recession. So even though that may not be the base case from a lot of these fund managers, a lot of whom will have doubled down so strongly on the US exceptionalism narrative, because the US in some regards is actually quite a self-sufficient closed economy, although it does business with the whole world and matters more than any other economy. There are a lot of companies in the S&P 500, a lot of the economy which can sort of drive itself without having to worry too much about tariffs. But I'd say the fact that the recession fears are here and don't seem to be going away, and I'd be quite surprised if they do go away anytime soon, means that the fear that I think that the B of A pointed to was that if those recession fears pick up or persist over the coming quarter, then the S&P 500 looks much more likely to be heading towards the 5,000 point level. If that were to happen, we could see in the next couple of months kind of peak to trough. So I think there was a February peak in the S&P 500 to a trough of 5,000. That's getting on for nearly 20%, which would be a very considerable, and we're not there yet. We're only about a third of the way towards a 20% write down. That could then sort of spiral into terrible sentiment feeds, terrible sentiment, panic selling, etc. So everyone knew that the sentiment had been pretty bad the last week. You just have to see price action for that. This survey really kind of doubled down on how bad things are from the eyes of those managing money and how quickly the tide seems to have changed.
Yeah, it has been a very rapid shift, although we should say things have been slightly better in recent days. Even yesterday, when the Federal Reserve did lower growth forecasts for the year, there was a bit of a rally, perhaps a relief rally, but the numbers you put out there were indicative, perhaps, aren't they, of you saying the S&P needs to get to 6,000, all these things would have to go right, which is only a gain of about another 5% versus all these things that could yet go wrong. That said, we always talk about climbing the wall of worry, etc. Right now, there is a lot more worry out there. By the same token, it seems to be fair to say that a lot of the impact of this, as one might expect, has been reflected in the Magnificent Seven, the big tech shares, the kind of company in which there has been a lot of crowding in recent years because they've done so well. However, in the past few weeks, they have really borne the brunt of this sell-off. You look at something like S&P Equal Weight Index is holding up better. So at this current stage, it's not been a disastrous performance certainly for the likes of the equal weight ETF, and it might suggest there is a rebalancing going on internally in the US market, as well as perhaps people looking to allocate more to the likes of Europe. We've spoken about that on the show in the past couple of weeks, the big increase in German defense spending, the fiscal package there, which passed this week. So maybe there's some checking of expectation, and we're not yet at a stage where people are starting to panic.
Yeah, no, 100%. Yeah, I think it is really important, almost to boil this down to real basics. What we're talking about here is separating some of the signals from the noise. Yes, there's been this big sell-off, but listeners will know, or if they don't know, that the big story in the US market in the last few years is that the biggest companies have been the most successful. They have also achieved the highest valuation multiples. You only need a few of these companies to be hit, and you would expect them to be hit when they are trading on such high multiples, because when risk sentiment adjusts, it's the most highly valued assets which are going to see the most relative hits to their pricing. So as you say, an equal weighted index does tell a different story. I saw another chart the other day that I think the Unhedged newsletter that the FT puts out, pull this out in another way, which is quite interesting, that I think the 50 worst performing stocks since mid-February, when the market peaked, they achieved a 100% total return in the preceding 14 months. And if you compare those to the best performing stocks over the last month in America, those stocks say are up about 9%. They were only up about 11% in the preceding 14 months. So in other words, yes, there has been this very brutal, quite quick sell-off, an adjustment in risk sentiment that has hurt some of the most highly valued stocks. But if you stretch the timeline out and see it in a bit more context, maybe this is a healthy correction, and maybe we need to sort of take a little bit of a breather and acknowledge that, yes, there was an enormous run up in the valuation of America's largest listed companies. So yeah, that context is also vital before we make too much of this short-term change in sentiment.
It does seem that what has happened, though, is that having not really taken the prospect of tariffs seriously since President Trump was elected in November, they are now being taken a bit more seriously because he has implemented various tariffs on various countries. The next big event in that regard, which everyone now appears to be waiting for, is April the 2nd, in just a couple of weeks' time, when we will see whether, or the extent to which, the reciprocal tariffs it said it will announce then, and the sector tariffs on strategic industries, so various sectors, various countries, people are now looking at that day as potentially a day when people will really, at least, if nothing else, have a clear idea of what the tariff regime is going to look like, because we've had a lot of back and forth and a lot of suggestions from Trump that these countries will be tariffed, these won't be, and then a little bit of backsliding, but still it's quite clear that there will be some levies on countries and different companies. Maybe we'll be in a bit of a holding pattern for the next week or two while people wait to see what happens there. Equally, I think it's fair to say that people, as I say, are taking this more seriously. The other question is the other side of things. You've also got, as I say, Europe looking stronger. You've got the UK being favoured a little bit more. There was a Deutsche Bank note out this week saying US clients were looking more favourably on the UK, partly because the grass is greener on the other side when things are suddenly looking a little bit worse in the US. It is fair to say that when you look at the nature even of a global equity index, which is tracked by most ETFs and very popular ETFs among investors nowadays, that the US is a huge percentage of that market, 65, 70%. So there is a lot of room for a rotation into Europe and UK shares to continue, also on a valuation basis. But that really does beg the question, Alex, is it fair to say, of what people invested in these global trackers might expect if this rotation does continue, given how much weighting the US has in a global product?
Yeah, as you say, 70% in US equities, I think. I can't remember if that was the MSCI World or the All Country Index, one of them. It's very, very high. I mean, historically kind of unprecedented, I think. And for that to adjust to levels that reflect the economic weighting of markets in the world, it's easy to see those relative figures and think, oh, wow, okay, so the US market has to fall by half over the next couple of years for us even to get a semblance of balance. It is a real and present risk, I think, for anyone who has bought into the global passive tracker story. And it's definitely something to be thinking about if you are concerned that there could be a much greater rebalancing from here. I think the caveat I'd say to that is that these things will probably take a while to work out. And although there's a huge discrepancy between the economic weighting of each sort of block and just how lowly, for example, Europe and the UK, and to say nothing of China, which as the second largest economy doesn't really even feature in global equity indices, although there's not a strong correlation in how those, the size of those economies are reflected. The weighting of American stocks in those indices is also a reflection of their enormous profitability and how that has accrued to particularly a handful of sectors which are effectively monopolies. And that isn't going to disappear. I think the Mag 7, with one or two exceptions, ability to churn out so much profit is not going to necessarily nosedive on all of this. The reason perhaps that American fund managers might be belatedly waking up to this imbalance, they're looking for a bit of diversification and hedging to perhaps their domestic story. If in a way, and I sort of might be speculating onto something a bit too broad in macro terms here, if what is being ushered in is a lot more of an economic nationalist global order, then it does also make sense not to put all your eggs in the America basket, because, as we've seen in recent months, the kind of tech triumph stories that are slowly coming out of China is just a reminder that actually that thinking in exceptionalist terms about one country is not a particularly smart way to think about the world on the long-term horizon. So in short, yes, there are definite fears about if, passive indexes or indices having so much of their weighting in the US, it will take a while to unravel if it is going to unravel. But it is also a reminder that diversification is not reflected necessarily in these indices, and that is always important to try and preserve in portfolios.
Another thing we should be mindful of is, of course, these narratives, they don't work as smoothly sometimes as one might hope, or might hope from a perhaps naive perspective. Insofar as I'm thinking here of the Europe story, which clearly has taken off a lot this year, the market has done incredibly well, even prior to concerns about the US really manifesting themselves. This week we had the news that the big German fiscal package that's got people very interested has passed, part of the political approval it needs to actually be put into action. At the same time, however, Julian, maybe I'll bring you in here because we've discussed this a bit in recent weeks. The passing of that has been, in the past couple of days, has been the sign for a small sell-off or bit of profit-taking in the likes of defence shares. So there is a sign, as the old saying goes, it's sometimes better to travel than to arrive, and you can't just rely on the narrative to keep going altogether. Is it fair to say that now is the case where in some of these industries, people are going to be looking for evidence of this great hope and this change in sentiment converting to top and bottom line, or are we thinking that Europe might still benefit regardless from the shift in allocations that we've just been talking about?
I think obviously it's a combination of several factors, but clearly there's a lot of profit taking on the back of the announcement. But that's a reflection of certainty rather than uncertainty, which is, I think, from an investment point of view, much more positive. The thing about, if you go into the mechanics of how the defence spending works, the problem that Europe has is that there are a lot of gaps in capability, and you're actually in a prime position where capital investment delivers 100% efficiency or 100% return if you don't have the capability in the first place. So the reason also why people are going into defence spheres in such a big way is that they can see that the efficiency of the capital allocation that is coming down the road, which in a sense has to be matched by orders, but considering that the amount of defence spending is ramping up already very quickly without the German contribution being factored in, orders are not going to be a problem over the next few years. As for the debate as to why Europe was doing better in January, I think there was already a sign that from that point on that people thought that the US story was a bit overblown and that there was a kind of hyper gloom around European shares, which is there's always this sign of, sentiment has gone far too far one way or another. So, if you're a canny investor, the smart money goes where the valuation is lowest because there is a kind of consensus which is a little bit behind the curve. I think that's quite interesting to see as well, that we were already experiencing a rotation before people realized that there was a rotation.
Well, it's still very early days. We've seen the start of a move. Who's to say how big that move will eventually prove? There have been various great rotations and great rotation narratives over the years that haven't played out as to the extent that moniker would suggest. We will keep tabs on this, of course, very closely. As I say, that is the April deadline for tariffs. There's also the uncertainty as to the extent to which the US government spending being cut will have an impact as well. And people are keeping a close eye on that because there hasn't been much evidence of that cut coming through in the numbers yet. But given the talk coming out of Doge and the like, it's fair to say we can expect more there. All of this, though, of course, the worst case scenario, not to end on a horrible point of doom and gloom this segment, but it would be that if a US recession does manifest and that tips over into global issues, and of course that could be the case with a global trade war as well, then it's difficult to think of places to hide, or at least places that will be flourishing in terms of risk assets in that scenario. But for now, there is definitely this shift going on. It seems Europe and the UK are benefiting, at least their markets are, from a slightly better relative state of affairs. We're going to look at asset allocation in a different way now, though. As I said at the top, our big cover feature this week is on the ultra-rich, how they invest, and the lessons we can perhaps take from that. Alex, why don't you set the scene for this feature and the way you wanted to approach the topic?
Yeah, sure. I suppose it's a bit of voyeurism. Everyone's up for a peek behind the gilded curtain of the super wealthy, be that sort of through reality TV or just the way we kind of idolize wealth or always have done. But in more practical terms, it was kind of simply just to ask the question to see if there is anything we can learn. I think instinctively we all kind of know that the very wealthy tend to stay wealthy. There is, fortunately for our purposes, some quite interesting aggregated data on how some of the very wealthy do it. So for this piece, there were two reports, one put out by JP Morgan's private bank and another by the same division at UBS, both of whom have sort of long histories of working with the world's elite, incredibly wealthy families. What's useful about these reports is that they kind of allow us to tease out some themes and some kind of attributes of how the ultra wealthy invest, which I think, in a couple of cases do offer some lessons to us mere mortals who don't happen to have $1 billion of family wealth.
There's various aspects to draw on there, which we'll get into in a minute, but you break things down into three main lessons in the piece, the way you look at things. I'll start with maybe the second lesson, because it's one we talk about a lot and maybe it can't really be emphasized enough. And that is about goals and goal setting and how perhaps, again, what we can learn from the way in which goals are set by this group of people.
Yeah, absolutely. Let's start grounded. How we often write and talk about personal finance. We're obviously talking about the balance between risk and reward and the goals, that most of us, in the great unwashed might not be to shoot for the moon. But broadly speaking, retail investors are trying to grow their pot in the market to make money. Is typically to achieve some retirement goal or level of financial security. When you've got all the kind of financial security you and your descendants could ever reasonably need, or retirement just, isn't so much of a concept, because if you have $1 billion, the life of work is maybe sometimes a little remote. The goalposts do change a bit. That said, the goalposts or the goals of the ultra wealthy are a little hard to pin down. They vary quite a bit. If you've gone to the trouble of setting up a professionalized kind of family office structure, you're employing 10 people, you've got $3 million of annual running costs just to manage your wealth, then it might make sense to say, look, I'm spending all this money on advisors. I basically have my own boutique investment fund. I need to set them targets to motivate them. I need to act like a proper investment fund with benchmarks, etc. It's the only way to kind of justify or make sense of that. So I'm going to set goals. I want to beat the, whatever it is, MSCI World or some constructed benchmark each year. But here is, how family offices and the ultra wealthy aren't like investment trusts. About half of them don't really set targets according to this JP Morgan report. And that's not because they don't matter. It's more likely because the targets that the ultra wealthy have in mind are either a bit wider or a bit nuanced. So it could be things like just preserving capital in real terms, or thinking over decades rather than years, or actually that the assets under management are being kind of stewarded for slightly more complicated purposes to do with family legacy and trust and tax planning. That once you're at a certain wealth point, you're thinking more about how you're dividing that wealth among your heirs, or what it might be. We often talk about market returns on this podcast and in the magazine, and that is instinctively what a lot of retail investors will measure themselves against. But I think when you have sort of already achieved the great wealth that few of us will ever reach, things change slightly. It's not because the very wealthy aren't motivated by growing their wealth further. There's a slightly different investor psychology once you've amassed wealth.
I think that's fair to say, yes. And the asset allocation of these individuals, the surveys do shed some light on that as well. It differs in some ways from the typical asset allocation, again, partly for the reasons you've just discussed. But can we talk about that in a bit more detail, and the kind of way they tend to split things up and why they do that, and in particular the allocations to unlisted assets, which are increasingly fashionable, fair to say, nowadays?
Absolutely. So, yeah. Caveat at the front that, because this is aggregated data and it's not actually based on enormous sample sizes. I think the JP Morgan and the UBS surveys are looking at a few hundred wealthy families. There could be distortions in that data, and this is not necessarily representative of any one individual family's wealth, but there is clearly a trend there. And as you say, the big differentiator between a retail investor's portfolio and a billionaire's is this allocation to alternatives, either private equity funds, venture capital, hedge funds. But there's a lot in there in private equity. This is typically at the expense of allocations to public equities, which, depending on which report you refer to, represents something like between a quarter and 30% of the average asset portfolio of an ultra high net worth individual. The other interesting point, I think, when you look at the breakdown of the assets, is the ratio of public equities to fixed income and cash, which I think, given their liquidity characteristics and ultra wealthy investors' preference for developed market bonds, we can kind of group together. They are kind of roughly equal. That implies higher caution than the average retail investor, who might be in the kind of wealth building stage of their investing journey. But it also points to a kind of liquidity buffer in light of those illiquid private assets that you mentioned, which are by their nature locked up for very long periods of time, aren't marked to market, and which therefore, even for the ultra wealthy, gives them amounts to restrictions on what they can typically do with those stakes.
As I say, that is the big feature this week. That is the cover feature. There's a lot more in there about those assets and how they're managed, and the lessons that could be taken by you or I, or the average IC reader or listener. So do pick up a copy of the magazine or have a look online for that. You can now get 12 weeks of an Investor's Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information. Now, though, we are going to look at Close Brothers, a company that has been dogged by several issues over recent months, specifically the motor finance investigation that we'll get to very shortly, Julian. But it put out interim results the other day. These followed on from a statement it put out last month, talking about slightly increased provisioning levels in relation to motor finance. Nonetheless, despite doing that a few weeks before, the market really didn't like these results either. Can we talk a little bit about them and why there was such a bad reaction?
Well, there was, yes. The shares fell 20% on the results day. The reason that people picked up on it quite so harshly was that there is clear evidence that their already high costs, are not coming down anytime soon, despite sort of the promises of the new management to get that under control. Also, this motor finance thing, it's not just the provision for potential compensation, it's all of the administrative and legal costs around it, which are stacking up quite significantly. They had a forecast for extraordinary costs for this year of between 55 and 60 million, 22 million of which are alone are legal costs, which I think is a lesson to all of us that we might be in the wrong business. It kind of came as a surprise, which in some ways is a surprise in itself, but it's just that there is more to this than just, we have to pay out this X amount of compensation. It is the burden that it's putting on the company in all sorts of other ways at a time when their loan book is flat. So essentially, revenues are not going anywhere because Close Brothers doesn't have the leeway to increase its lending. And at the same time, these extraordinary costs that they're enduring just keep going up and up. So that's why the market basically hated the results themselves. There's also this Supreme Court trial, which is coming up on the 1st of April, which is going to test all these arguments around the motor compensation scheme. So there's a lot of uncertainty about what the outcome of that will be. I think we might even send one of our reporters there, who was a former legal reporter herself, Gemma. It is, in short, a situation that no company wants to find itself in. And investors are kind of voting with their feet on this one at the moment. There is a bit of commentary around saying, well, okay, this is starting to look interesting as a sort of speculative investment. But the problem is we don't quite know where the knife is going to fall or how far the knife is going to fall. So before you even attempt to catch it, you've got to be certain that all of the issues are resolved in some way or another. And as things stand, that effectively the market's saying that they don't think that there's any line drawn under this yet.
There is this case on the 1st of April, as you say. Clearly, the start of April is a big date in this podcast, a date where people are going to be looking at various things. I think Trump did say the reason those tariffs, to refer back to them, were happening on the 2nd of April was because the 1st of April people wouldn't take him seriously. Clearly, the Supreme Court doesn't have such issues. That said, this case is running, I think, from the 1st to the 3rd of April, but the result won't be, you can talk about results of a court case in this way, won't be out for a few weeks after that, and then FCA guidance after that. So there is going to be uncertainty for a little while yet.
Oh, it could be months. I mean, the wheels of justice turn slowly. And the reaction of the FCA is the unknown quantity as well, how it has to take into account whatever the judgment is. And nobody can put a price on this. I mean, that is essentially why shares fall under regulatory uncertainty. There is no final figure. If there was, then I imagine that people would start to look at it seriously again as a value share. But nobody knows what the bill is or where it's going to land.
There has been, I think the FCA, they've certainly been making noises about a redress scheme. So I think whatever the outcome of this case, and some analysts are more positive than others, as you'd expect, there is going to be some redress going through. Clearly, banks, Close Brothers, Lloyds as well, have provisioned or made some provisions for this already. So the question is whether they need to increase those or not.
Well, I would have said they had to increase them. I mean, if only to take account of the fact of the toll it's taking on their operations,
Indeed.
which is an unknown contingent cost, isn't it? I mean, that's the issue. Investors are just are steering clear. So there is going to come a point where this is going to look very good value, but I don't think we're quite there yet.
All that said, we do have the company on a buy because the shares are pretty dirt cheap at the moment. This is Close Brothers. I think there's some concern maybe that a capital raise might be needed if the result is particularly bad. But given the valuation at the moment, for those who are keen on a bit more of a more speculative share, this may offer some potential, albeit, as we've just covered, they have to ride out the volatility or potential volatility in the meantime.
Oh, it's definitely an all or nothing at this point. So have to. I mean, the downside is really the cash in the company. So that's what's represented by what's left in the share price. But it is. You've got to be able to stand a lot of risk on essentially a 50-50 coin toss, really.
Well, the government, of course, also tried to get involved in this case, which was rebuffed by the Supreme Court. The suggestion or the reported suggestion, because I don't think it's been officially confirmed, that they were looking to ensure that the results of this case wouldn't be too arduous. Anyway, we will see what actually happens in the coming weeks as that case is heard and then reviewed, and then the outcome is eventually known. But for today, we've reached the end of the show. The outcome is known here. So thank you very much to Julian and to Alex for all your thoughts today. We have run out of time, but we'll be back next week with another Companies and Markets show.